Michael Burry just gave another powerful economic warning. I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over the bullwhip effect. This is what Michael Burry has been talking about. And Lance Roberts just wrote a fantastic article on the bullwhip effect in Zero Hedge. We'll put a link in the description below. But a quick chart that really tells the story is a chart of retail sales compared to inventories, or the inventory to sales ratio. Editor, go ahead and throw up the chart, and we can see it has skyrocketed lately. And this means that the stores, the retailers, are holding way too much inventory compared to their sales. And this is a very ominous sign for the economy. So how does this rather esoteric, mysterious bullwhip effect actually work? Let's check it out right here on the whiteboard. It starts off with your drunk, insolvent Uncle Sam giving stimmy checks to everyone in the economy. And the average Joe and Jane takes their stimmy checks, their free dollars, to the local store. We'll call it XYZ store. And this store is owned by Retail Randy. Now, all the average Joes and Janes are going to Retail Randy's store to buy none other than their Rebel Capitalist Show t-shirts. Of course, what else are they going to buy with their stimmy checks? So because of their new free money, they buy 50 of these Rebel Capitalist Show t-shirts from Retail Randy. So he says, wow, look at the demand for all of these shirts I'm selling. See, Retail Randy doesn't make the connection between the stimmy checks and the amount of shirts. He just sees it as aggregate demand. So he assumes the economy's booming. He listens to all the talking heads on CNBC, on Bloomberg. He listens to Jim Cramer saying, buy.
Right here, right now.
The economy is on fire right now. And he listens to Joe Biden, Jerome Powell, and Janet Yellen say how amazing things are because the unemployment rate is so low. So he figures that he's going to see this type of demand into the future. In fact, the demand is probably going to increase because before he was selling, let's say, 10 t-shirts. Now he's selling 50. So next month, he thinks he'll most likely sell 100 t-shirts. So he calls up the wholesaler. We'll call him Wholesaler Hal and of ABC Wholesalers. So he says, Hal, I need 100 t-shirts for next month because demand is exploding higher and it's only going to continue to grow. So Wholesaler Hal says, wow, Randy, that is great news. Well, if you're ordering 100 shirts, I'm going to go ahead and order 150 shirts from the manufacturer because I want to make sure that I have enough to fill your order if you increase it. The last thing I want to do, or the last thing Randy or Hal wants to do, is have too few shirts for the amount of demand, then they lose out on sales. So although the demand starts for 50, it grows to 100 and then 150 because these individuals in the supply chain want to order even more than they think they'll need just in case demand increases so they don't lose out on sales. This is the bullwhip effect in action, meaning a small snap of the wrist at the beginning has a bigger and bigger impact as it goes down the supply chain. So Wholesaler Hal calls his buddy manufacturer Mike and he says, boy, oh boy, we need 150 of these t-shirts ASAP. So manufacturer Mike goes out and sources the cotton, we'll say the chemicals, and this little green squiggly line, obviously thread for the t-shirt. My artistic skills shining through as always. And he says, my gosh, this demand is so incredible. We're going to have to hire more people to sew these or create these t-shirts. So he hires 3 more of the average Joe and Jane, and he sources all of this material, all the commodities. So what happens to commodity prices? They go screaming higher. But you guys can see the problem with this. Lance Roberts, in his article for Zero Hedge, calls it the sugar rush. So the government comes in, gives all the stimmy checks, your drunk, insolvent Uncle Sam, because he wants to buy those votes. But unfortunately, the average Joe and Jane isn't going to have this demand in the future. They're not going to have this purchasing power. It was only temporary. So fast forward to the next month, or let's say the next quarter, now all of these individuals in the real economy are broke. That's why they're frowning. They're very sad because they don't have those stimmy checks from the government. So they buy 0 t-shirts from Randy the retailer at XYZ store. So then the ABC wholesaler, Hal, calls him and says, Randy, how many shirts do you need for this month or this quarter? And Randy the retailer says, unfortunately, I don't need any because I didn't sell any of the t-shirts I ordered from you last month. So the same thing happens with Mike. Mike calls Hal, and Hal says, nope, don't need any more of those t-shirts. I have plenty of inventory. And Mike says, oh my gosh, well, I hired all these people to create the t-shirts, and now I have all of this stuff. Well, I'm definitely not going to order more stuff. Demand goes down. What happens to price? Most likely goes down as well. And then he lays off all of these workers. The unemployment rate goes even higher. And then those workers in the real economy have even less purchasing power the next month to buy things from the XYZ store and retail Randy. So when you're seeing all of these retailers like Macy's, Walmart, Target slashing their prices because they have way too much inventory, this most likely is a result of the bullwhip effect that Michael Burry is warning about. Step number 2. Now let's go over the economic impact and think through what the bullwhip effect Michael Burry is warning about will do to the CPI. In other words, the rate of consumer price inflation. And this gets very interesting, nuanced, and as always, the devil is in the details. So let's go back to what we were talking about in step number 1, where all the average Joes and Janes don't have enough money to buy their rebel capitalist t-shirts. So XYZ store has no sales. Retail Randy has an excess of inventory. So he has to drop his prices to get any revenue that he can generate. And the same thing for ABC Wholesaler. They have all of these additional rebel capitalist t-shirts, so they're going to drop their prices. And as we said before, manufacturer Mike has to fire or lay off all of these new workers he hired because he thought he was going to need them indefinitely into the future because of the sugar rush demand your drunk, insolvent Uncle Sam created. So aggregate demand in the real economy goes down. These workers don't have the same purchasing power they had before. Also, we see the unemployment rate most likely go up and up and up. Now let's think through what happens to the headline CPI, meaning the rate of consumer price inflation. And here is where it gets super fascinating. So I think we get this bifurcated type of inflation where everything you need, such as food, energy, shelter, is going up in price, while everything you don't need, like clothes, electronics, and maybe going out to restaurants, those prices come crashing down. So the main takeaway from step number 2 is the economic impact from the bullwhip effect will increase the probabilities that we go into a recession if we're not already in one right now. And as far as consumer price inflation, it goes back to what I've been saying on the whiteboard videos for the past couple months. And my base case is that in Q3 or Q4, the headline CPI starts to come down. Let me be very clear. I'm not predicting that we will have deflation, meaning prices coming down in aggregate total. What I am saying is this bullwhip effect that Michael Burry has been warning about increases my confidence level that we will see disinflation toward the end of this year or moving into 2023. This is where the prices are continuing to go up in aggregate total. Very important because, like we said earlier, there's a lot of nuance in disinflation or this CPI. But I believe we'll see disinflation where prices are just going up to a lesser degree. And that takes us right back into the government's response for potentially disinflation, which might mean that we're in a recession, if not an economic depression. And you know as well as I do, the government's response will most likely be more stimmy checks and more deficit spending, most likely where the Fed drops rates back down to zero and starts quantitative easing all over again. Oh, but wait, there is more. If we have the bullwhip effect going one way, we can also have a reverse bullwhip effect going in the complete opposite direction. We're going to discuss that more throughout the rest of this video. Step number 3. Now let's discuss the reverse bullwhip effect. You're going to have to use your imagination on this one. I really stretched my artistic ability to its limits. And this is a timeline, believe it or not, and a very rough timeline, we'll say. So we've got all these squiggly lines going all over the place here. So the black line is demand. The blue line is supply. The red line is inflation. And this is how I kind of see it playing out with all of these variables regarding the bullwhip effect, a recession, the economy, and consumer price inflation. So going back to 2020, we had the cerveza sickness. So demand pretty much stays the same. We thought it would plummet, but the government came in with this era, we'll say, of stimmies. We'll call it the stimmy era from, I don't know when it was, call it April, May, something like that, to the beginning of 2021. So demand doesn't go down. Demand actually increases throughout this time frame. So on the supply side, initially it plummets because we have this global issue, this pandemic. So all the retailers are saying, well, my goodness, the governments are locking everyone in a cage, so they're not going to be able to come out and buy Rebel Capitalist t-shirts. So we're going to order far few. We're just going to sell the ones we have. And remember, demand is staying pretty consistent, if not going up. So supplies goes down or inventories go down. But then they see that demand, shockingly, isn't going down. It's actually going up. So they start to order more, but we have all of these supply chain issues. So they can't order all of the supplies they need. So the inventories continue to go down as the demand from the stimmies and the sugar rush, we'll say, continue to go up and up and up. So this creates the problem that we discussed in step number 1, where all of these retailers just assume that the economy is booming. And that's why we have all these people spending money. And they're going to continue to spend more and more and more indefinitely into the future. So they start ordering as much supplies as they can. Inventories go up and up and up because as soon as they start to order more inventory, the demand starts to go down because the era of the stimmy check has ended. But maybe just temporarily. So then we get the bullwhip effect coming in full force. So the inventories skyrocket higher like we saw in that chart in step number 1 as the purchasing power of the average Joe and Jane continues to plummet. And as a result, almost forgot about inflation. We go back to this red line. So as the purchasing power is increasing because of the free money and the supplies of stuff going down, inflation going from 2% to 5% to 6% to 8.6%, maybe even higher. We'll have to see because the next print comes out in a couple days, July 13th. More on that in just a moment. But then we get this disinflation because the purchasing power runs dry and the inventory skyrockets higher. That's what I was saying in step number 2. So I drew this little quick chart here of the CPI. On the left, we go from 0% up to 10%. This is just pretty much 2022. So January to December. Starts off in 2022 at about 7.5%. June, and that's the print that we're going to get July 13th. So just here in a couple days, they're going to tell us what the CPI is for the month of June. We'll say it's about 8.5%. And then because of everything we've discussed in this video, I see the inflation levels or the CPI print going down. Remember, CPI as stated by the government, so it's wildly understated. But that headline number goes down. Now, what we get after that, this is the big, we'll call it $20 trillion question. Because as the inflation level goes down, because of this bifurcation we talked about, so the stuff you need going up in price, the stuff you don't need going down. Now with restaurants, that wasn't a very good example, I'll admit right now, because their food costs are probably going up. So they might not lower prices, they'll probably just go out of business. But it's all about the concept, and I think you guys get it. So let's go through this kind of step by step. Fed introduces a massive sugar rush. The supply chains overstock. We need to order more stuff because we think this demand is going to infinity and beyond. Then we have a profit recession, and most likely going into an economic recession. The yield curve has inverted. Commodity prices are crashing down. The price of gold, the dollar skyrocketing. All of these things you would expect to see if we're headed into a recession, or the things you would expect to see if we are already in an economic recession. So supply chain orders decrease massively, and then we come in with Fed Sugar Rush 2.0. Because right about here, we have this disinflation that we discussed right in this chart, and supplies at all-time highs, this profit recession, corporate profit earnings are absolutely plummeting, and then we see demand going down as well. So all the central planners at the Fed and the federal government come in with more and more stimulus checks, more free money, and that takes us right back into this cycle where demand skyrockets higher once again. But I think in the future, it may be a little different, because you would think we would go into another cycle of the bullwhip effect. But I think this could happen at the end of 2022, maybe going into 2023, to where all of these retailers, remember retailer Randy, or is it retailer Rick? Anyway, but all these retailers have the bullwhip effect PTSD. They remember what just happened. It's like, no, we're not going to order more supplies. We're going to wait and see how this plays out. So you have inventories absolutely plummet down to a level lower than they are today when you look at that sales to inventory ratio. And what this does is this takes the inflation level to another upswing where it probably goes higher than wherever it peaks in Q2 or Q3 of 2022. And this would be very consistent with the inflationary decades that we have seen before in the 1940s and the 1970s, where inflation doesn't go up in a straight line. It goes up, comes back down, and it goes right back up again. There are no certainties, only probabilities. But I think this is the economic roller coaster ride we're going to be on throughout the rest of the 2020s. We'll have to see how it plays out. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.